JP Morgan's got more legal headaches. Should Fannie Mae and Freddie Mac pay us dividends? And we take a look back at our fantasy stock draft. You're in the right place, folks, because this is where the money is. David, it's Monday, so we're going to do what we do every Monday and every day. We're going to start off taking a look at the headlines. Right off the top here, at the end of last week, we were looking at some more legal headaches for JP Morgan. There's some scrutiny over hiring practices. This comes from the New York Times. The headline was "Hiring in China by JP Morgan Under Scrutiny." What's your takeaway here? Well,
during the intro, when you said it's another Monday, another day, we're going to start it off like we do every day, I thought you were going to say another JP Morgan legal headache. That's
a good point.
It seems like that's the trend these days. And the thing that stood out to me in the article was a JP Morgan spokesperson came out and said, "We're being extra careful with what we disclose." They said this type of inquiry by the SEC, in the past, they may have not even disclosed this and said that the SEC was looking into it. So they're being extra careful because of the London whale. As a shareholder today, yeah, it's annoying to keep seeing these things. They can't keep their name out of the mud. But until this really starts to impact the earnings and what drops to the bottom line and builds that book value over time, I'm not too concerned. Don't you want to be ahead of that? Don't you want to be running for the hills long before it hits the earnings? Maybe, but I don't see this hitting the earnings. It's
okay.
Still, I mean, you think about their client base. Is anyone going to pull their business from JP Morgan because of this news? Maybe. Maybe a couple people, but on the whole, I think people are looking at the value proposition that JP Morgan still offers them and says, I'm going to stick with JP Morgan, I'm happy here. So don't take this as conspiracy theory here, but I'm thinking, I don't want to say that JP Morgan is being targeted, but if you think about, you've got the London whale situation, which put a lot of spotlight on JP Morgan. Like the other big banks, they've been investigated for a lot of housing crisis era types of shenanigans. So I wonder if there's the extra close eye on JP Morgan is revealing stuff like this that otherwise maybe wouldn't come to light. The idea that JP Morgan would be hiring well-connected individuals in hopes of getting business. I hate to sound cynical, but that doesn't really sound that surprising. Whether it's in China or whether it's in Europe or whether it's here in the US, well-connected people are well-connected people. If there was more to it, I mean, there's good reason for the DOJ to crack down here, but otherwise, I hear this. Well, they're hiring well-connected people. They got some deals from the well-connected people. Doesn't sound too surprising to me. And even if we just think of worst-case scenario here, because some people might be thinking, okay, Bank of America had a lot of lawsuits, and that put huge concerns on their liquidity position. Why isn't the same true for JP Morgan? I think just the nature of these arguments and inquiries, they're much different looking at what JP Morgan is allegedly doing as opposed to what Countrywide did and the billions of mortgages that they wrote before the housing bust. So I think it's not all lawsuits are obviously created equal, and I think you're seeing that. You're not seeing JP Morgan's stock price take a nosedive 30% like Bank of America did in 2011 over all these liquidity concerns. So I think that's just where the difference is. I don't see these as that big of a deal. If there's a 30% nosedive, I'm a buyer. Over at Slate Magazine, we've got Matt Iglesias writing about Fannie Mae and Freddie Mac with the headline, "Fannie and Freddie should pay dividends to you and me." Essentially what he's arguing is that instead of the dividends that Fannie Mae and Freddie Mac are paying to the government basically, and the government's using to pay down the debt, they should be coming to us. And this gets to sort of a central debate in government fiscal politics right now, and that's whether funds should be used to reduce the deficit, to reduce the debt, to pay down the obligations of the government, or whether there should be more spending to stimulate the economy, which is still growing sluggishly. I'm with those that want more spending. I think the system was sort of broken when we had good times, and during the good times we were running deficits. Economic good times, because usually what you want to do is when the economy is booming, you take the excess money, you reduce the deficit, you pay down some of the debt, and then you have the firepower when the economy is struggling to be able to do a little bit more spending. We sort of broke that because we swung the other way, and now times aren't, I wouldn't say times are bad, but they're not great, so you want to be able to spend more. I'm not sure that I like the idea of just giving out the Fannie Mae and Freddie Mac dividends, but
that would lead to more spending, very likely. And the other thing I like about it is that it might clear up the logjam of doing something about Fannie Mae and Freddie Mac. I think as long as this is a free flow of money to go against the debt, it just encourages the government to let the status quo continue.
Whether it goes directly to the Treasury or directly into our pockets as taxpayers, the one party that's likely not still getting anything is the shareholders, the common shareholders of Fannie Mae and Freddie Mac, the people that still hold those common shares, those preferred shares. They're not getting anything as everything's being swept to the Treasury. So again, this still points to
You're a fan of giving it back to them, aren't you? Private shareholders.
Not, well, I'm not going to take a stance there. I'll take the stance that I don't think people should be buying those common shares today. We saw Bruce Berkowitz come out and potentially buy more of those preferred shares. Again, that's Bruce Berkowitz. He's very specialized in these special situations. I don't think it's something that the average day retail investor should be messing with. Fun story to watch. I wouldn't put my money behind it.
On Fannie Mae and Freddie Mac paying you and me, don't think it's going to happen, but an interesting thing to think about nonetheless as we look ahead to what the government is going to do with the two of them. Finishing off over at FT, we've got a headline: HSBC and Stand chart hit by Asia focus as economies lose momentum. We got Asia starting to slow down a little bit, concerns that it will slow down even more. This is painful. This is potentially painful and is painful for HSBC and Stand chart, who do a lot of business over there. But I was thinking back home here in the U.S., among the big U.S. banks, the one that would jump to mind as being impacted by this is Citigroup. As a Citigroup watcher, would you be concerned about the Asia slowdown for Citigroup's business?
I think you have to be a little bit. That's the risk you're taking with Citigroup, as opposed to, you look at Wells Fargo. They're North America. They stay with North America. They don't venture out too much. A little bit of their markets business, investment banking business, will go internationally. But Citigroup, more than 50% of their revenues are coming outside of the U.S. That's the risk you're taking. You're exposed to much more of these geographical, I don't know, what's the word?
Fluctuations. Wiggles.
Yeah.
The
It's
wiggles
kind
of
of
the
just,
economies.
That's the risk and reward of Citi. People look at the U.S. and say, maybe it's not going to grow that much over the next 5-10 years. I like Citigroup because they have that international exposure. This is the downside to that. This is the other side of the coin, that with that potential growth, you're getting these other exposures that can potentially drag down the results.
So I looked at some of the numbers. Over at Citigroup, about 30% of the deposits are from Asia. That's about $101 billion. That's a pretty big chunk there. But when you look over at the rest of the results, 22% of consumer banking income is from Asia, 17% of securities and banking income is from Asia, and then 30% of transaction services. So the actual operating results aren't quite as high in terms of the weighting there. But when we compare it, the reason that we wouldn't have seen FT highlight Citigroup in this discussion, HSBC and Stand chart both get, or I should say both got, approximately 60% of their pre-tax income from the Asia region during 2012. So for them, this is a very big deal. To me, Citigroup, when I look at it, yes, you're more exposed to Asia, you're more exposed to all of the emerging economies, which, like you said, it's a good and a bad thing. It's a double-edged sword. But I think any further weakness in Citigroup's stock on Asian concerns, I would potentially see it as a buying opportunity. If you like the Citigroup story overall, it's already, the stock is already priced pretty pessimistically. So if it were to go down further, you've got a lot more cushion there for things to go wrong.
Right.
Moving on, last week we did a fantasy stock draft here on Where the Money Is. And I thought we'd take an opportunity to go back and review our #1 picks, so that you can admit, David, that you reached in the first round and are going to get crushed.
We shall see.
By my first round pick. Your first round pick, JPMorgan. Why did you go for it first round, and do you think it was a reach?
So with the draft, just a side note, we had to take one bank, one insurance company, one REIT, and then one other. So right off the board, I grabbed JPMorgan. We look at the banking space. I think banks are fairly undervalued or fair value right now. So when we think about the big banks, JPMorgan, Bank of America, then the super regionals, US Bancorp, and then those regionals like a Synovus or Huntington Bank shares, those ones further down the chain there. I look across the spectrum of the banks. I really do see the best value with those big banks, and specifically JPMorgan. We see their name dragged through the mud continually, but every quarter, quarter in, quarter out, they post record results, great results in investment banking, mortgage banking during the refi boom. Consumer banking is still strong, one of the biggest consumer banks in the US here. The stock's only trading at 1.4 times tangible book. This is a company that has double-digit returns on equity. Over the long haul, I just don't see, minus if these legal things really do become something.
At what point do they really continue to do something? I mean, are regulators going to? Are these going to be giant fines? Is that what we're talking about, or is it more about regulators requiring them to stop doing certain things, certain types of businesses? Or when we think about this new China scrutiny. Do they have to reduce their business in China? Do they have to have extra regulatory oversight that'll be more cost? I mean, what is the big downside that you see for that?
My biggest concern isn't the regulation or the regulators making them do stuff, making them not do stuff. My concern is with the clients. If clients start to leave JPMorgan, that is when I would be concerned. Otherwise, in one of the most recent conference calls, Jamie Dimon said, we're going to work through these accounting changes. We're going to work with the regulators. So they're going to figure that stuff out. I'm concerned with what the clients are the biggest companies in the world still using JPMorgan to do their mergers? Are all these consumers in the US still using Chase as their bank? If those numbers start to go down consecutively, I see multiple quarters of people leaving the business declining, that's when I get concerned. I don't see that happening, so that's why I'm confident with that.
You were the second pick overall. The first pick of the draft went to Billy Kipper stock with Berkshire Hathaway. If you had had the first pick, would you have grabbed Berkshire before JPMorgan if you had the opportunity?
I would not have.
You would not.
I'm comfortable with my pick. Great, it's a good pick.
Warren Buffett, man.
It's a solid pick. You can't argue against that. But we're talking about long-term value here, 5, 10 years. I really do see JPMorgan as a bigger winner than Berkshire.
Berkshire is a solid pick. I agree with you there. I would think of it more as at this point, at the valuation that it's at right now, more a really good offensive lineman. You're not going to win a lot of games if your offensive line is weak, and Berkshire Hathaway is there at the core of your portfolio, doing your big time blocking, opening up the holes for your running backs. I think I'm stretching this analogy a little bit too far, but I think about the first round as a time for running backs, wide receivers, quarterbacks, the ones that are going to make a really big, noticeable impact. That's why I went with AIG. So you've got the insurance exposure there, similar to Berkshire Hathaway, but unlike Berkshire Hathaway, you've got a 0.7 times price to tangible book value multiple. You're talking about 1.4 times being attractive at JPMorgan over AIG. This is stellar. Now, the other side of that coin is that you've got a 7% return on equity at AIG right now. I think that's a temporary thing. Part of that is over on the life insurance side of the business, low interest rates make that part of the business much more difficult. In fact, if you look across the life insurance industry, you'll see very low valuations because the business is tough right now, and investors see that. They see low returns, and they're bidding down the shares. As we see a change of the guard in the interest rate environment, as interest rates start to come up a little bit, that'll create opportunity there. That'll bring returns up there. I believe there'll be volatility in the middle, and that'll be the difficult part. But longer term, I think about AIG today versus before. So you've got the reduced exposure to the financial products division, which caused all the problems. From a leverage perspective, and when I think about leverage, I often think about it in terms of assets over equity. So the asset leverage, 9.9 times in 2007, so assets were almost 10 times equity. Today, 5.5 times. So you've got renewed focus on global core insurance business. This is a leader in global insurance. You've got a low valuation, and you've got a safer business and less leverage on the balance sheet. I think this is a brilliant first round pick.
I'm not arguing.
And I think that is going to shine. Unfortunately, that's going to shine over the next 5 years, 10 years kind of period. I think it's going to be a fantastic investment over that time period. But over the next year, it's anybody's guess.
Right, and we should mention that we do have all these in a caps account to hold us accountable over those next 3, 5, 10 years. And I think it's at what, TMF stock draft. There we go. TMF stock draft 13. You can follow all the 20 picks between Matt and myself, Brendan Matthews, stock advisor, and Billy Kipperstock from Motley Fool Pro. So they're all in there.
Absolutely. Now moving on to a new segment that we're going to call The Dumbest Thing I Read Today. And as much as I love the Wall Street Journal, this particular piece comes from the Wall Street Journal, and the headline is, "Financials are the big performers, but beware." I think part of the reason that this caught my eye to begin with was the article starts out with, "Contrary to popular belief, notorious thief Willie Sutton never said he robbed banks because that's where the money was." And that's, that caught my eye because that's where our show title comes from, where the money is. What the article basically argues is that financial stocks have been has been a great sector to be invested in currently, but as we look forward to the rest of the year with interest rate volatility, interest rates rising, it'll be a much tougher go. And I'll read another little section of the article here. "An environment of low interest rates, rising asset prices, and growing risk appetite has been good to the financial sector. Bank of America saw its earnings per share rise 68% versus a year earlier, while insurer American International Group rose 38%, and investment bank Goldman Sachs saw a 108% increase. Not only did financial firms generate the best growth, but they had the highest rate of positive earnings surprises during the quarter." My problem with this is that the low interest rate environment hasn't been particularly good to a lot of banks. There have been some opportunities for them, but the rate spreads, the spread between what they earn on all of their lending and what they pay for funding, that's been ridiculously low and falling. And so rising interest rates, maybe not right now, and maybe that's the disconnect here between this article and where our thinking is, that over the next year, it could be difficult. Over the next 6 months in particular, it could be difficult. But we don't think about it in that perspective. I think about it 5 years. You think about it 5 years. This just seems too Wall Street, too short term, too Wall Street for me. What do you think?
I tend to agree with you.
You tend to. You tend to. You
no,
don't
I
always.
agree. I agree with you on this. He mentions that they've had a good run, and then they're probably going to hit some headwinds here. You still can't deny the fact that banks and financials are trading well below historical multiples.
Well, let me give you some numbers there since you brought it up. Year to date, the big four, JPMorgan, Citigroup, Wells Fargo, Bank of America, all up year to date 20 to 30% of the stocks. Trading multiples, JPMorgan, as you mentioned earlier, 1.4 times tangible book value, Bank of America, 1.1 times tangible book value, and Citigroup trading slightly like a 5% discount to tangible book value. If you want to argue that one may be a little bit stretched, it could be Wells Fargo, 1.9 times tangible book value, but the returns there are so high. There's the numbers.
Yeah, I mean, you look at the numbers there, they don't look overheated per se. I mean, if the market conditions do get a little tougher, I could see bank stocks trade down a little bit. That's what the market does sometimes. But like you said, over the next 5, 10 years, the environment and the valuations look fairly attractive now. And it reminded me of a quote from Bruce Berkowitz, the fund manager at Fairholme Fund. He said, "I don't understand why we measure performance one rotation of the Earth around the sun." It's an arbitrary number, 1 year.
Completely arbitrary.
It's arbitrary.
It's ridiculous.
And we do anchor our returns on years, and that's just the way we do it. But it's arbitrary to say they've had a good run over the last 8 months and might not last. So you have to look at the fundamentals of the business. What are the returns they're generating? What's the valuation? And think about it over those 5, 10 years. So I'm with you. This is off base.
The article ends with, "If there is one thing bank investors can learn from bank robbers, it is having the sense to take the money and run." Completely disagree. What I'm going to be watching, we brought up the big four banks here. What I'm going to be watching at these big four banks are the stories, are the progress, are what's going on in the operations. Is Bank of America getting past its legal troubles and growing? Is Citigroup capturing the opportunity in the emerging markets and elsewhere in the globe? Is JPMorgan burnishing its image rather than continuing to stomp on its image? And is Wells Fargo, I don't know, continuing to be Wells Fargo, right? That's what I'm going to be watching. If the volatility from interest rates sends the stocks down some towards the end of the year, I will look at that mostly as a buying opportunity.
Yeah, that's an interesting way that he ends it there in terms of should this be a time where bank investors should be selling? Because I'm sure there's a lot of people out there that bought Citigroup, bought Bank of America, and they may be up 100% on their position. That's very possible with these stocks. I think what you have to do and ask yourself is what the market giving me right now with this valuation, is it completely unreasonable? Is this unreasonable? Is this a lot more than I think this bank is worth? And I think if you step back and ask yourself that, a lot of people will say, no, I still think this is a fair valuation, if not still a cheap valuation for these banks. So until the market's giving you a price that you think is, okay, this is more than what I thought this bank was worth, I don't think you should be selling just because you're up on your position.
The week is young, David. There's plenty more for us to be digesting as the week goes on. What are the particular events that are going to be happening this week that you're looking ahead to?
Well, there's one on Wednesday. I'm not particularly excited about it, as you may know. The FOMC minutes.
You love the Federal Reserve, David.
I don't love it. I'm going to be combing through all those pages looking for the word taper. That's the first thing I'm going to do. No, but that's released on Wednesday, and I'm sure everyone's going to be watching it. Again, I don't think it's very important. We are seeing interest rates move up. The 10-year rate is moving up again today, inching closer towards 3% there, not quite there. The one group that's really taking a hit again on this are the mortgage REITs. We saw in early July, all the mortgage REITs were just crushed during that whole taper, tantrum, whatever thing. They're back in the news now. Armor down big today. CYS investments down big today. These are going to be on my radar this week. It's going to be a volatile time for them again, and it's really going to come down to how are each of these firms positioning themselves with their portfolios. Did they scale back their leverage the past quarter? So I'm going to be watching that on Wednesday. Not necessarily as I'm not going to try to jump in if you're not
going to be day trading the Federal Reserve release.
I'm not. So I'm going to be kind of watching that. Now, are you paying any attention to this?
Oh, of course I'm going to be paying attention. I'm not the cynic that you are. I'm going to be watching for the timing of everything that's going on. I'm actually more excited on balance about the idea of interest rates rising, and hopefully the Fed continues to be open and transparent with its communications and lets us know what it's thinking, even as we look ahead to the potential changing of a guard at the Fed as Ben Bernanke looks to make his exit. I'm going to be listening for those signs of taper. I'm not going to be trading based on it, but I'm going to be thinking about it in terms of how I'm analyzing the banks, how I'm analyzing everything in the financial industry. I mean, this is a very big deal, what interest rates are going to do, and the timing and the pace of the interest rate change and what the Fed is doing is going to have a big impact over the next 6 months to a year.
And one other event that's not related to the Fed, and we've seen most companies have reported earnings, second quarter earnings now. That's kind of getting out of the way. During earnings, it can be just a flood of information. Don't have time to really digest the earnings. The one thing I'm going to be watching this week is a presentation. So not an earnings release, but a presentation from New York Community Bancorp on Thursday at the Raymond James Conference. This is a bank that's been on my radar, die hard, devoted to that dividend of theirs. They stuck through it through the financial crisis. That's why it caught my eye. They're very devoted to this dividend. And we talked about the REITs earlier. A lot of people go to those for dividend plays. I think New York Community Bancorp may be one that's a little bit more conservative, not as volatile with these interest rates. So that's one I'm going to be watching. It's the 20th largest bank in the country. Not huge. They focus on multifamily lending in New York City. Great market there. So they're going to be presenting on Thursday. I'm going to be watching that.
If they're talking about any economic and banking indicators, is there anything in particular you're listening for there?
I kind of want to just hear, is the bank doing normal, boring banking things? Is credit quality good? What are they hearing from lenders out there? Is there demand for these multifamily loans out there? So I just want to hear, I don't want to hear about the Fed. I don't want to hear their take on it. I want to hear how their business is doing. What's the appetite for lending in their space?
And how about a little JPMorgan to finish off here? There are no scheduled events for JPMorgan, but we're starting off the week with JPMorgan in the news again. I'm curious how long this news cycle lasts, how long the conversation continues on what's going on here, because as you mentioned earlier, there are a variety of risks when it comes to the legal issues at JPMorgan. So one of the risks is the actual fines that they'll face. Another risk is curtailment of businesses if the investigations reveal something that's bad enough that they're required to, for some reason, curtail business. That could be a very bad outcome. But another big one is the headline risk and the perception of clients. And so the longer the news cycle lasts, keeping JPMorgan in the headlines, talking about what they're doing wrong as opposed to what they're doing right, that's bad for the bank. So that's one thing I'm going to be watching as we move ahead to the rest of the week.
I think with JPMorgan, it could be maybe it's just a slow news week the last couple of weeks, and everyone's focusing on JPMorgan. The next, maybe there's another taper tantrum, and everyone's going to forget about JPMorgan, and it'll be out of the headline.
Or they just have it out for you and your number one pick on the stock draft.
We'll see. We'll see.
All right, let's finish off on the Twitters. David, why don't you take us out with your favorite 3 tweets of the day?
Perfect. All right, the first one we got about Fannie Mae and Freddie Mac. All that cash Fannie and Freddie sent to the Treasury may be premature given their accounts played down loan losses. And then he links out to an FHFA document there criticizing the way Fannie and Freddie are documenting their loan losses when they are accounting for these losses. And it reminded me of one of the arguments that you've continually brought to the forefront here of those people interested in investing in the common shares of Fannie and Freddie. Mm-hmm. It's that these results right now, they look great. $10 billion profit, $5 billion profit respectively for the two. Profits have been great, but the scenario is not exactly normalized here. We've seen provisions, we've seen benefits from provisions rather than setting aside losses here. So I think this just highlighted that you can't take these results in a vacuum and assume that these are great, profitable enterprises and then they can do well for the next 5-10 years without any government involvement in a normalized accounting environment. So I think this just highlights what you were saying.
Yeah. Now let me be perfectly fair here. That if there was an announcement that came out today that definitively said Fannie Mae and Freddie Mac are going to be returned to private hands, to private shareholders, there would be value in the shares where they currently stand. So you've got a big discount there for what I see as the very low likelihood that actually happens. But then past that discount of the fact that it might not return, that they might not return to private hands, like you said, you've got not a normal environment that they're operating in terms of insurance companies have to set aside provisions for losses. They're not doing that. So you cannot just take today's profits for either of these companies and say, I'm going to project this out into the next 10 years. And that's what they're going to earn. Right. Just not going to work.
All right, the next one we got is around Zillow. One of your favorites. One of the reasons you're going to retire early from the Motley Fool. Got a tweet from Brian Bolan. Hope I'm saying that name right. He says Zillow is running circles around Trulia. That's the ticker for Trulia there. Secondary offering will go to traffic and technology acquisitions. So we also saw Zillow make an acquisition of Street Easy, a New York based website that does a little something similar to Zillow. They bought them for $50 million and also announced that they're offering more shares. I think it's a good move. I like the move for Zillow. And the comparison to Trulia is in this space, there's not a lot of huge moats in terms of the information that Zillow and Trulia get. A lot of it's public information that most companies can source. It's the fact that they're getting eyeballs onto their site, which then they can promote to their subscription holders, which are real estate agents.
Because they have that nifty little Zestimate thing,
right? Zestimate. Everybody loves it.
Everybody loves it, except when they realize it's not that accurate,
They're like,
right?
I thought my house was worth a lot more. But yeah, I like the acquisition. In this business, with what they're doing, they have to get bigger. It's all about scale. It's all about getting in front of people. And with that secondary offering, they're going to have the cash to make more acquisitions, invest in the technology. And I think that's why I think he hits right on the point there with the tweet that they're going to continue to get bigger than Trulia. They're already about twice the size in terms of market cap from where Trulia is, and I think that will continue to grow. I like the decision.
I saw that Trulia ticker symbol, and for a second I thought I was seeing Tesla because everybody's been talking about Tesla. I think if there are two stocks that have been in a little bit of a hyper loop of their own, it's been Tesla and Zillow. I think I think you're right. I think this is a good move. Issuing shares to make the acquisition. Two reasons that this is good. First of all, scale. Just like you said, this is a burgeoning industry in terms of serving real estate customers online, and so somebody's going to win. Somebody's going to be out front, and Zillow wants to be it. And so the more scale they can get, the better. It's not a guarantee of a win, but it's a path there. Second thing is, I think Zillow's expensive. I think the stock is expensive. So that is exactly the time that rather than going and buying back shares with extra cash, you issue shares. And that's a good corporate finance move. So I think, solid management there.
There's been a lot of people that said Zillow's so overvalued, and yeah, maybe it's a little over.
Good, use it.
It's a little overheated, and it's not the company's fault.
Keep
it's not
doing
management's fault. I think you got to give them a round of applause that they see that their shares are maybe a little overvalued at the time, and they're going out in the market and taking advantage of that.
Sure, I applaud them for that.
Last one we got up here is from Dividend Master at Dividend Master with 3% on 10-year calling. Be aware of the leverage differentials among the mortgage REITs. And this is something that we talked about, I think, last week on the show, that not all these mortgage REITs are equal. Different leverage levels, different holdings in the portfolio. And you're seeing that come through today, the last couple weeks. Armor, CYS, American Capital Agency, all down big. These are all companies that are a little bit more levered up than an Annaly Capital or a Two Harbors, which is only around 3 times levered there.
Which is also on my stock draft team.
It's on your team there too.
I will point that out.
So yeah, AG&C, Armor, down big, Western Asset Mortgage Capital around 9 times levered. So if you're interested in these mortgage REITs, really understand where that leverage sits. And go and look at what the comments from management said. We saw from Annaly, they were saying, we're comfortable with scaling back leverage right now. We don't think this is an attractive time to be very levered up at 8, 9 times. On the other hand, you still see American Capital Agency and Armor, they're still levered up a lot more than Annaly. And if those interest rates still going up, those book values are going to continue to take a hit.
I'll be a little bit boring here for a second. I think it's just a good time to have a reminder that this is not a simple industry. This is not see a big dividend, buy a big dividend. There are major differences in the way these companies are run, are operated. We look at I'm looking at the results today so far, and again, we don't focus on one-day results. But today you've got Armor down 7.3%, like you said, so far. Two Harbors down about 2.5%. And that reflects the differences in the way these portfolios are managed and the stance that management has taken. And in the mortgage REITs, it's all about that jockey. It's all about that jockey and what they're doing. So investors that are in this sector really want to understand what the balance sheet looks like and who the investment managers are and what they're doing.
Yeah, absolutely. Get into those SEC filings, as exciting as they are. Get in there, find the facts, ask the right questions, and you can ask us questions too. We're on Twitter there at TMF Financials. Feel free to tweet us a question. We'll address it right here on the show. So yeah, again, just be very careful. Not necessarily stay away from the sector. We're not saying that these are all bad necessarily, but just be aware of what you're buying, aware of what these funds actually do.
Of course, they're not all bad. As an Annaly shareholder,
not all bad.
You obviously have some soft spot for the mortgage REITs. For David Hanson, I'm Matt Koppenheffer. This is where the money is, and we will see you tomorrow.